We're going to give everyone just a few minutes to get comfortable and enter the meeting, and then we'll go ahead and get started. Okay, good morning. My name is Brant Steck. I'm Vice President at BUI, and on behalf of the entire BUI team, welcome. Before we get into our presentation, I just want to hit a couple of quick housekeeping items. First, this meeting is approved for an hour of continuing education credit for Missouri Life and Health, Indiana Life and Health, for Missouri continuing legal education, and for certified financial planners anywhere in the country. To apply for your CE, go to the bottom of your screen where you'll see a toolbar and you'll see a chat feature. I have already posted a link that all you have to do is click on that link, enter your credentials, and we'll see to it that you get your cover or your credit. We'll continue to post that link throughout the discussion. In addition, if you have questions throughout the presentation, go to that same toolbar and go to the icon that's labeled Q&A. We will do our best to aggregate the questions and then get those questions to our speaker at the end of the session. Now, on to our speaker. Our speaker today is Michael Tesler. Michael is an absolute expert in all things life insurance, from crafting the initial discussion with clients about income replacement and identifying their needs that we're actually talking about today, all the way to the most complex estate and business planning topics. You could not possibly work with a more client-focused individual than Michael. His client friendliness absolutely permeates throughout the organization. It's the center of every staff meeting, every training, every case discussion, and our number one core value, trying to make the recommendation that we believe is in the best interest of clients. And it all starts with Michael. He is the National Association of Insurance and Financial Advisors namesake for the Silent Hero Award. He is the 2018 Moores Award winner. For those of you who are not familiar, in the BGA space, that is like a lifetime achievement award, and he's the youngest to have ever won it. And as I said, someone who you can absolutely trust to have the best interests of your client in mind at all times. So without further ado, BUI's president, Michael Tesler.
Good morning, everybody. Brant, thanks so much for those kind words. And thanks to everybody who's joined us today for taking a little time out of your morning. I really appreciate it. As you can probably, for those of you that I don't know, you can tell from the color of my beard. And for those of you I do know, you know I've been doing this a long time. And in that period of time, I've heard a lot of things said about the life insurance industry. And some of that commentary I agree with, and some of it I like, and admittedly, some of it I like less than other parts of the commentary that comes in about life insurance. And some of it just kind of baffles me and causes me to really think about how did we arrive at such a thought. And I'd like to start today by talking about one of those things, and that is this concept that life insurance is sold, not bought. And I've always wondered about that one. It always kind of bothered me. Now, I recognize if somebody wakes up in the morning and is thinking, I need to go to the grocery, I need to pick up eggs and milk and what have you. Yeah, nobody wakes up and thinks, oh, I need to get out and get some life insurance. So in that sense, yeah, maybe it's sold, not bought. But really, we're talking about something that plays a critical role in a financial plan. And I'm always kind of wondering to myself, why would that statement ever have been? And I can tell you, it predates me. I mean, it's been around forever. Like anything where you would say, bought, not sold kind of thing, I would submit that there are a lot of contributing factors. One of them probably that it's just not understood. And it's really difficult for clients to understand the need, the purpose of the insurance, all kinds of things. And I think that better understanding helps any important decision. I would also tell you that especially when we are talking about permanent life insurance contracts, we as an industry have come up with some of the most cockamamie, crazy, complicated products you could ever come up with. And I've joked more than once that does it really take a 60-page illustration to explain how a life insurance contract works? And admittedly, even if you were an accountant and an attorney and an actuary all rolled up in one, first of all, you probably wouldn't get a lot of cocktail party invitations, but all kidding aside, even if you had all that expertise rolled up into one, you would still find life insurance illustrations to be difficult to understand, and not as consumer friendly as we would like them to be. In addition to that, in the topic of complicated product, I don't know if you've ever looked at the prospectus for a variable life insurance contract, for example, but nowadays everything's electronic. But when I go back far enough in my world, I can tell you the prospectus for a variable life insurance contract used to be about this thick, like a phone book from a small rural area. I mean, not a small document. And the idea, which was always a good one, was disclose everything you can about this and try to give the consumer everything they could possibly need to understand it. Unfortunately, with the complexities associated with it, it's hard. And of course, as an industry, we've not done ourselves a lot of good in terms of reputation, and that's tough. Some of it our fault, some of it not. For example, we're on 30 years of declining interest rates, only turned the corner within the past year, and that declining fixed interest rate market has translated to an awful lot of underperformance in the permanent life insurance space, which hasn't bode well for the life insurance industry. And of course, there's so much stuff around the core value, which is the death benefit, the protection that life insurance plans provide, and so much other stuff that didn't help our reputation as an industry altogether. And while all of those things are likely contributing factors to the sold not bought thing, I will tell you that after a lot of conversation with a lot of advisors and their clients, and by the way, I owe all of them a big thank you, because it's that input that I get from the advisors that work with BUI. It's the input I get from their clients as I work with a lot of advisors and their clients. It's that input that provides what I believe is really at the heart of the matter, and that is that there's been a lack of a needs analysis that was performed at the time that the discussion around life insurance began. And we're going to talk in much greater detail about what is a needs analysis process. But interesting to note, our friends at the Life Insurance Market Research Association tell us that nearly 3/4 of life insurance buyers purchased the amount of insurance that was recommended after a needs analysis was performed, which is obviously quite different than when a needs analysis is not performed. And that those who were provided a needs analysis bought nearly twice as much insurance as those who didn't. It's not about the fact that they bought this much bigger amount. It's the fact that they understood they needed a much bigger amount after they understood the process of going through a needs analysis. Now, all of us like to talk about some of our more interesting or exciting plans, and certainly as it relates to the life insurance world, many times we're talking about a business succession plan or an estate plan where life insurance was used as a tool in that plan to help the success for the client. But while we all love to talk about those, I want to remind you of something. Estate planning, especially when the need for estate liquidity is addressed via life insurance, we're talking about a teeny tiny number of people in this country who actually are going to bump into an estate tax situation, and therefore, again, that same teeny tiny number who are looking at using a life insurance plan to help with the liquidity that their estate needs. The vast majority of plans that are put in place in any given year are, in fact, for the purpose of replacing income. It is the number one reason cited by consumers who make this purchase every time, and it's way out in front of everything else. In addition to that, the vast majority of the plans that are put in place for income replacement purposes are term insurance plans. And we talked earlier about the complexity of permanent insurance, but keep in mind, again, we're still talking about a much smaller percentage of people out there who are buying permanent insurance as compared to the number of people that are buying term insurance. And when it comes to income replacement, and we know that there's a finite period of time for the need for coverage, there's a lot of really good reasons why term insurance is so popular in this space and is recommended by advisors day in and day out. Now, a minute ago, I mentioned that there's this teeny tiny fraction of the population that's going to need liquidity for their estate. But when it comes to needing term insurance or any insurance for that matter, for income replacement purposes, the percentage looks, you can't see my hands, much bigger. Because whether your client earns a great deal of money or your client is at the other end of the spectrum, it really doesn't matter. If that income is fueling that family, which it is in most instances, then the need for insurance to replace that income should something happen to an income earner is critical. And for most of your clients, they understand that this is something they should probably be doing for the people that they care about. They have some understanding about the concept of income replacement, but that's kind of where it stops. I am always surprised when I am invited into meetings with advisors and their clients how little people know about life insurance, things that many of the people who have joined us today take for granted every day. Is the premium guaranteed? Such a simple thing. And you're all thinking, well, if you buy a 20-year term insurance plan, it's guaranteed for 20 years. And in reality, many of your clients don't know that. And let's face it, it's not their fault. How many things in your life will anybody guarantee for 20 years? Not very many. So clearly there has been some real misunderstanding out there. And of course, the biggest misunderstanding, in my opinion, is the death benefit. And not so much what it is but what will it do? And we're going to spend quite a bit of time this morning talking about that very topic because it is a critical part of each and every plan that you put in place for your clients. So advisors have told me in almost no uncertain terms that as they look at implementing a risk mitigation plan for their clients, that there are three parts to that plan that every time when these three things are handled appropriately, it is a successful plan. The first one is the need. And clients need to understand the need, and they need to understand it very carefully. And oftentimes there is far too little time spent with clients discussing what the need is, how to understand the need, et cetera. And again, we're going to go into that as well. The second is the amount. This is a huge disconnect. A client sees a number followed by a bunch of zeros, and it kind of sets them back like, wow, is that too much, too little? How did you get there? And we're going to talk about the amount of insurance as well. And then lastly is the result. And what I mean by result is not the amount of insurance, but much, much more importantly to your client is what the amount of insurance will do for your client. And that is absolutely critical for them to understand. So when the need, the amount, and the result are all clearly understood, your client is ready to implement a plan to mitigate risk. So let's spend a minute or two talking about the need. Life insurance companies have a team full of very creative people to help make life insurance look and sound and feel more exciting than it is. And I have to admit to you, as I said, I've been doing this a long time. It's not that exciting. And they're going to talk about things like mortgage cancellation or endowing an education or debt repayment or any number of other ways to make the life insurance sound more appealing to clients. And I understand their motivation for doing that. But when you think about retiring debt, or when you think about paying a mortgage, or when you think about funding an education, there's one word has to come to mind every time. And that word is income, because it is income that will in fact fund all of those things. And I said it before and I want to say it again. When your clients look at what fuels their life and their lifestyle and what they do, the answer is income. And they truly need to understand the critical role income plays in their life to really understand the risk mitigation plan that needs to be put in place to protect for that income. In addition to that, when your clients think about all these different things that they have in their life, whether financial obligations and all kinds of other things, they don't always necessarily translate that back to their income, and they need to. So as we discuss need, it's very clear that clients need to understand income a little bit differently as they look at risk mitigation. And we will be talking about that in greater detail shortly. So then let's talk about the amount. And there's so much confusion around the amount. Again, clients just don't know what to think of it. And you'll see, if you sit in meetings with clients and advisors, as I get to do, you can see the look in their eyes when an amount gets suggested. Like, wow, that sounds like a lot, or that sounds like a little, or where did that come from? And it's really critical for clients to really get their arms around why did this amount get recommended? And for many clients, they don't get to that next and important step. So there's an amount that's been recommended, but that amount isn't the important part. The important part is what will it do for me? One thing I can tell you that never happens is nobody ever thinks that it's a lottery win. And what I mean by that is, at the time that an application is being taken versus the time that a death benefit is paid, nobody ever gets a death benefit thinking somehow that there was a lottery win or that it was a windfall profit for anybody when it comes to that life insurance death benefit amount. The real question that they want to know is, how is this amount determined? Now, there's a lot of financial advisors who've been kind enough to join us today. Thank you, by the way. And those financial advisors, many of them use a very, very, sophisticated and great software for client management, for asset management. It's great stuff. And they spend a lot of time with clients, and clients love these conversations when they're talking about getting to retirement. So if I put this much more money away between now and when I retire, my pool of money at retirement will be this much bigger, and therefore the stream of income that it will be put off will be this much bigger. Well, what if I change the amount that I'm currently saving and I add more to it? How much more will be there at retirement based on a set of assumptions for growth and what have you? And therefore, how much will I have for income? And what if I retire 5 years later than I was originally expecting? Or what if I retire 5 years sooner than I was originally expecting? And there is software that will do all this modeling for people and let them see, this is what happens if you do this, then this. And how did we determine that this is the amount of that we're trying to shoot for in retirement in terms of the total amount of retirement assets versus how much those retirement assets will provide during retirement years? They understand this, they buy into it because there has been a reasonable set of assumptions applied to their situation that help them to determine what their retirement might look like. And yet, when it comes to life insurance, I too often hear from clients, advisors, and others that somebody just like pulled an amount out of the air. And it makes the client wonder, well, gee, where did that amount come from? And did you suggest that amount because I have a spouse and I have 2 children, and the last 10 clients you visited with that had a spouse and 2 children, you thought that they would, that it would recommend the same amount? Is this the amount you recommend to all your clients? Like, how did this come about? And it's pretty important for people to understand that. I want to share a quick personal story with you. Last week, a very dear friend of mine lost his house and belongings to a fire. I am happy to tell you the family is fine, all good on that front, but they've lost it. And, you talk about determining an amount of insurance. Imagine this conversation, they contact their insurance advisor and say to that person, our house, all the belongings, etc., are gone. And the insurance advisor says, I'm really happy to tell you that we had a risk mitigation plan in place. But the not so good news is I only recommended that you insure for about 25% of the value of your home and your belongings. It's a preposterous conversation that would never happen. But I want you to know something. When it comes to life insurance, it does happen. And we're going to talk more about that. So what you are seeing on the screen in front of you is one of the simplest needs analysis tools that you could ever put together. And it is available to you on a document from BUI, and you can reach out to any of us to get that document. The document's called Do You Have Enough Insurance? And what this tool provides is an opportunity to look at your client's income versus the number of years until they retire. And simply put, I can just run down this column and figure out, oh, my client makes $100,000 and they are 20 years away from retiring, which takes me over here. And I now know that they're going to need about $1.5 million to replace that $100,000 income for the next 20 years. Now, that's really important for your clients to understand. We're starting to get to the what it does. And more importantly, when this tool is used, there is some real understanding around this death benefit. You have to wonder what, without this, and if there's just a recommendation of $1.5 million of death benefit, how would that have resonated with the client? But when the client knows that it takes $1.5 million to replenish their income or replace their income for the next 20 years, that $1.5 million starts to make some sense. Now, this is the simplest needs analysis tool that you could possibly use. There are some really sophisticated and complex needs analysis tools that you can use. And admittedly, there are bunches of needs analysis tools. In fact, through BUI alone, there's got to be at least 3, 4, 5 different needs analysis tools that you can use. And as I mentioned earlier, our friends who have joined us today who are financial advisors and have some of that great software that's used within their industry, almost all of the better software packages have a module built into them for doing a needs analysis for risk mitigation purposes. I am not here today to advocate for any given needs analysis tool. I am here to advocate for the use of a needs analysis tool to help your clients better understand the importance of having a plan in place and using a tool like life insurance to help implement that plan. So, as many of you know, BUI provides quotes to advisors, dozens and dozens daily. In addition to that, lots of advisors like to go onto our website and run their own quotes. And whether they go on there and they use the Vive platform for running term insurance quotes and then ultimately submitting, or whether they get it from us, I see the quotes that are going out to advisors. And I am shocked, really shocked to this day, at how many quotes go out to advisors that are in the neighborhood of $500,000 of death benefit. And the reason I'm surprised, to be honest with you, is because as you start to think about $500,000 of death benefit, I'd like you to kind of get inside of my head for a minute. Because what's going through my head when I see that $500,000 quote is, well, this client obviously makes $60,000 or less and is 10 years or fewer away from retirement, because that's what a $500,000 death benefit will do. It'll replace a $60,000 income for approximately 10 years. Now, being a bit inquisitive and really interested in all of these things and having quite a passion for the life insurance business, I've gone and followed some of these transactions from the time of quote till the time of policy. And I've gone in and done something that not everybody is in a position to do. I've gone and looked at the quote that went out to the advisor, at say $500,000. And then I've gone and looked at the application. And when I go to look at the application, the first thing I look at is, well, what was this person's income? And in almost every scenario, the client's income was greater, and in many instances, far greater than $60,000. The next thing I look at is the client's age. And I'm trying to determine, as you may have guessed, how far away from retirement is this person? And again, in almost every scenario, the client appears by age to be a lot farther away than 10 years from retirement. Now, there are some factors that might mitigate why somebody would need an amount of insurance at $500,000. One of them is pretty simple. What if they have existing life insurance? And so I go to the part of the application where a client is asked to provide their in-force insurance coverage. And what I've come to see way too often is that either they don't have coverage, or the $500,000 they're applying for is replacing an existing $500,000 of insurance coverage. And again, I'm still shaking my head. Now, there's another thing that might offset the need for all of that insurance coverage, and that is that client may have substantial personal assets that makes them believe they don't need as much insurance. And of course, on a life insurance application, there is a portion of the application that asks about your client's personal finances, income, net worth, et cetera, et cetera. And so I go there and I check, and sure enough, the assets that have been suggested on the application do not give any indication that $500,000 of insurance is going to be a sufficient amount of coverage. And so in a huge percentage of these transactions, what I've come to see is that these people are very, very underinsured. And underinsurance is dangerous. It's dangerous for a lot of reasons, but what you really don't is for a client is do that check the box thing. And if you're a planner, an attorney, an accountant, whoever do you have insurance? Yes, check the box. The real question that needs to be asked is, do you have a sufficient amount of insurance? And again, going through a needs analysis process really helps to check that box. But what you really don't want to see is a client that is woefully underinsured. Now, when we talk about the amount of insurance that somebody has, it's very interesting when we're talking about these $500,000 policies, to take us away from the time that the client was implementing the insurance to the time that a beneficiary is making a claim. Now, most of you know that BUI has a policyholder service unit that provides service to all of the advisors who are helping their clients with their existing life insurance policies. And admittedly, a lot of the work that's done by the policy service unit relates to a change of bank, a change of beneficiary, a change to a premium mode or something like that. But also, I will tell you that most of the claims for the advisors that work with BUI start with our policyholder service unit, where they are contacting the service unit to say, I've been made aware that my client passed and I need to start the claims process for the beneficiaries. And when the amount of insurance is $500,000 or less, and frankly, almost no matter what the amount is, but there's a question that the advisor is way too often asked by the beneficiaries. And by now, I'm guessing you know what that question is. I can't see your faces, but I'm guessing some of you are actually mouthing it to me right now, and I'll save you the suspense. The question that they get asked is there more? And that really starts to hit at the heart of the disconnect between the amount of insurance and what that insurance will do. At the time that they were buying, that $500,000 may have seemed like a sufficient amount, or perhaps it was driven by how much premium was associated with putting $500,000 or more in place. Whatever drove the decision at the time that the life insurance was put in force, sure is different than when you get to the time of claim. And every advisor who's ever delivered a death claim or had a client pass will tell you things have really, really changed when you go from the time that the insurance was being put in force to the time that you are working on a claim. And so when you see this, you have to ask yourself some questions about the amount of coverage. How will my client understand the need? How will they understand how the amount was determined? How will they know what the benefit will do for their family? And none of these questions should be taken lightly. At no point should you assume that the client knows the answers to all of these things, because in most instances they don't. But the answer to all these questions and more is the use of a needs analysis tool. And as I said earlier, there's a lot of different flavors of needs analysis tools out there. I'm not advocating for any one tool. What I am advocating for is the use of that needs analysis tool and the important role that it will play in your client wanting to implement a plan to mitigate risk to their family. Now, as you look at the various needs analysis tools, you will see certain things are common with all of them. And we're going to go through some of that right now so that you understand the, the, the important role of going through the process with your client. So let's start with step one, which is gathering basic information. And it is just that. It is basic information. There is not a need. For example, a lot of our financial advisor friends who are on this call with us today, they know you've got a compliance regulation, know your client. You are asking every single thing about a client as it relates to their risk tolerance and all kinds of other things to help to make appropriate recommendations. When it comes to gathering information for this particular risk mitigation tool, you don't need nearly as much information as you would for something like that. I deeply encourage you to involve your clients in the whole process. The whole thing changes when your client is invested not only in the end result, but in the process of putting in the data, gathering the data, knowing where, why, and what, and where. Now, I mentioned earlier that a lot of the financial advisors who are here with us today have incredible software packages and have a tremendous amount of data about their clients. And in almost all of those packages, there is a module for risk mitigation that likely includes a needs analysis. And they're very good, don't get me wrong, but there's something that they do and that I would encourage you to sort of step outside of it. Those modules draw information from the other modules in the planning software and sort of pre-fills all the information in the needs analysis information gathering. And your client's not really involved or invested at that point. And then when it's done, it pops out with this number and it says, this is what you need, Mr. Client. And I encourage you to go through it with them. Don't just wait. Don't just take them to the end result and say, this is where we got to. Take them through it so they know how you got there. It's important for them to see that this is not as complicated as they think. They do way too often believe that this is an overly complicated situation. It doesn't have to be. For a tremendous number of these plans where you are implementing a plan for risk mitigation, term insurance, which is the simplest form of life insurance, is the plan that is used. The needs analysis is really straightforward and really easy for your clients to understand. It really does help take something that they perceive as being complicated and makes it a whole lot less complicated. And then lastly, it's no longer about you making a recommendation to them. It's more about them telling you what they need. Again, that whole buy and sell and all that, this is behind us. This is not happening when you use a needs analysis tool. What is happening is a discussion around a plan that is going to provide what is necessary for a family in the event that something like this should occur. it also allows you and your client to get together on the what ifs, something that most, again, financial advisors are very familiar with. If I'm visiting with my client about their retirement plan, we can do the what ifs. What if this happens? What if that happens? What if I contribute more? What if I contribute less? What if I retire early? What if I retire late? There's so many different parts, and ultimately the client is helping to make the decision of what to do and how to do it to arrive at the goal. In addition to that, it lets your clients let you know what they're thinking, as opposed to just making a recommendation where your client is sort of in the dark. So let's talk about the process for a needs analysis. As I said, we first start by gathering information. Now, what you are looking at here is a snippet from an actual tool, a needs analysis tool that BUI has prepared and makes it and is available to everybody here. Again, you need only send to us an email message or reach out to one of your friends at BUI and say, hey, could you send that to me? And we'd be happy to do it. And I'm going to do a little pre-filling here on this tool. We are going to use Mr. Jones. I didn't mean to snub Mr. Smith or John Doe. The three of them have all been used in every PowerPoint presentation going back, I don't know when, but today we've got Mr. Jones. Mr. Jones is 48 years old for our example. He is hoping to retire at 65. Mr. Jones earns $200,000 a year, and you will see that we've made some assumptions about rates of return, inflation, et cetera, et cetera. Mr. Jones happens to be married, and as luck would have it, to Mrs. Jones, who is 47 years old, also hoping to retire at 65, and also makes $200,000 a year. Now, we are about to get to a really important part of our presentation today, so I hope I have your full attention. This is something that most of your clients have never really given a lot of thought to and never really seen. It is the present value of their future income. It is taking what is the present value of all those years of that $200,000 income. And it's probably the first time that your clients have ever really looked at this number and said, wow, that's what my income is worth. And wow, my ability to earn and the fact that I do earn is worth a great deal of money to my family. And for most people, the present value of their income is far larger than any single asset they have, far larger than any single investment, far larger than their home. It is a big number relative to everything else that they have. And that is really critical for understanding the need for and the amount and everything else for the insurance. Now, understanding this present value takes us to the next step as it relates to the needs analysis. And that is, are there other things that your client might like taken care of at the time that they pass? So things like, I want to make sure that my kid's college is funded. I want to pay off my student loans. I want mortgage and other outstanding debts to be retired. Now, if you're thinking to yourself what you should be thinking, which is, well, all of those things are fueled by income. So if I replace the income, do I need to actually do these things? The answer is maybe not, but for a lot of clients, it is a personal preference. It's something in their mind that if, God forbid, something happens to me, I really want all of these things taken care of, in addition to the replacing my income. Now, whether or not it's a great idea for your client to use that death benefit to take care of all those things, well, that's something between a client and their financial advisor. As an example, if your client was wise enough to have either refinanced their mortgage or bought a new property when mortgage rates were sub 3%, and something happens to somebody, Mr. or Mrs. Jones in our example, is it really in their best interest to retire that mortgage Again, I would leave that to a financial advisor, but it's highly likely that's not such a great idea if you're sitting on a sub 3% mortgage. And if you have a risk mitigation plan in place that will make it easy to continue to pay that mortgage. But again, that's a personal preference thing. For our example today, I am leaving it blank. Now, there are a couple of other factors that might impact the amount of insurance needed to replace your client's income. One of them is assets. If your client has substantial assets, and I am not talking about retirement assets. Keep in mind, we are talking about what happens up until retirement, not what happens after retirement. So if they have substantial assets, that is something that probably should be considered as you do this. And of course, if they have existing life insurance, clearly that needs to be added in here to determine what would be an appropriate amount to replace their income. And again, I've left these blank for Mr. and Mrs. Jones, and that brings us to this very, very important part of the needs analysis. And as you will see from here, based on the information that Mr. and Mrs. Jones provided, and I'm hopeful, in my mind, I'm picturing you and Mr. and Mrs. Jones all working together to input this data, arrive at this point, and then we'll use Mrs. Jones to see, not that Mrs. Jones needs $2.8 million of insurance. No. What you want them to see is that by implementing a plan, Mrs. Jones's $200,000 income will be provided to the family if she passes until she was scheduled to retire. In addition to that, that there will be $15,000 available for immediate expenses like funeral and things like that. This is not the important part of this page. This is the important part of this page. It is understanding not what the death benefit is or how big it is, but more importantly, what will the death benefit do? And this is an interesting discussion, again, especially for financial advisors who have joined us here today, in that, for your clients' income earning years, it's all about grow money. It's all about winding up with the biggest possible nest egg you can at 65 or whenever it is that they plan to retire. If it's like the Joneses here, it's at 65. It's grow money. But as soon as they turn the corner on retirement, it's not about grow money. It's about how much will my nest egg provide in terms of income for the rest of my life. And advisors use some awesome software, as I already discussed, which includes, for example, a Monte Carlo simulation, that point at which a client's retirement assets and all of their needs, wants, desires, and can be thrown into a modeling system that will take all of their information, run it through thousands of iterations, and tell them, if you draw down this much income from your retirement nest egg, we expect in hopefully a large percentage, but an X percentage of the time that your assets will be with you all the way till the time that you pass. And again, similar concept here, except instead of starting when your client reaches retirement, we're talking about providing that all-important income before they retire if somebody should pass. And when they reach this point of recognizing not that this is the important part, but that this is the important part, everything changes. This is no longer a buy or a sell or anything like that. This is about a plan to mitigate the risk of the loss of an income to a family. And by taking them through that needs analysis process, your client is really invested in all of this. They have a really great understanding of the need. They've seen what the present value of their income is, and they've come to realize going through this process that their income is likely the single greatest asset that they have. In addition to that, this wasn't an amount that was just pulled out of thin air or anything like that. It wasn't the amount recommended to the last 10 clients or anything else. The amount was determined by very understandable and reasonable calculations. And that is critically important for your clients. And I'm not just talking about your engineering clients. All of your clients want to know that this was arrived at through understandable and reasonable calculations. And then it becomes very, very clear not what the benefit is, but what the benefit will do. And I can tell you that advisors report unequivocally that the conversation totally changes. It is never about selling. It's about understanding and determining a need. It's about explaining how risks can be mitigated and implementing a plan, not buying or selling, planning. And that is a critical part of the whole process. I would like now to kind of shift gears and talk about a few real life situations as reported to us by advisors. And I think you'll find these interesting and see where we're headed here. In this first example, the advisor used needs analysis software and it calculated an $8.5 million need for coverage. But that's the end of the story. The story begins with a client who contacted that advisor and said, hey, this insurance guy contacted me and suggested $2 million of insurance, and I'm wondering if you can get it for me any cheaper. Sound familiar? Well, after meeting with the client, the advisor said, let's pump the brakes a second here. Let's go through a needs analysis to determine how much insurance you need and then discuss how best to achieve the goal. And they went through the needs analysis process, and sure enough, it resulted in this client needing an $8.5 million benefit. And what I can tell you is that this is a surprising moment for a client to see something like that. But the result was that this client put an $8.5 million death benefit in force, preventing them from being extremely underinsured. And that $8.5 million death benefit, more than 4 times the original suggested amount by another advisor. And again, think carefully about what would have happened if something, God forbid, happened to this person if they were insured for less than a quarter of the amount needed to replace their income. Now, I have to give you a content warning right now, because we are going to talk a little bit about a couple of situations that actually involve death claims. And again, as I said, these are all real situations as reported to us by advisors who work with BUI. The first one is a young couple who met with an advisor, and again, that $500,000 magic death benefit was suggested. And in fact, both husband and wife made the purchase of $500,000 of death benefit. But things took a very different turn for these people when at a very young age, the husband tragically and unexpectedly passed. Now, if you were paying attention earlier, and I told you when advisors contact us and tell us about putting in a claim for a $500,000 death benefit, that there's a question that the beneficiaries always ask. And I'm hopeful that you all remember that question, because it is the exact question that was asked here. And that question, of course, is there more? And it didn't take long. At the time of purchase, $500,000 probably sounded somehow reasonable to these people. And when it came to the time of claim, didn't seem so reasonable anymore. And it was very clear that the family was going to, based on their lifestyle, needs, expenses, wants, etc., they were going to burn through that $500,000 pretty quickly. Financial aid came to these folks through friends and family, and even a GoFundMe campaign to raise additional funds for these people who were left in an incredibly difficult situation. Certainly not the kind of financial plan that anyone puts together, and certainly reminds us all that it is critically important to address this with clients at every age, at every end of the financial spectrum. It's really, really important. Our last one is about a stay-at-home spouse, and more importantly, that stay-at-home spouse's executive spouse. Some years back, an advisor contacted me and said, I have secured a meeting with a very big executive at a rather well-known company here in our town, and asked that I join at that meeting. And at that meeting, we began discussing the request from the client, who also had an existing policy and was basically considering replacing it because that policy had reached the end of a level premium period for term insurance. in that meeting, we had the "Do you have enough life insurance" document. That's the little grid that I had in the slides earlier. And while we were sitting there and the advisor who was with me had that document in his hand, the client reached across the table and sort of grabbed the document out of his hand and started reviewing it. Not long after, she looked up and said, "You know something, based on this, I think the death benefit amount should be increased to $6 million." Again, the needs analysis tool really helping this client get their arms around how much coverage was actually needed. Unfortunately, this person died several years later, leaving her non-working spouse with a very appropriate amount of coverage. And while no one can help with the grief that occurs when somebody passes, there is certainly ways to mitigate the financial disaster that can occur when somebody is either not insured or underinsured. And I hope that all of these examples really highlight the importance of going through the needs analysis process with your clients. This brings me to the end of my remarks today. I would say you all have been awesome, but I can't see you. So I'll assume you've been awesome, and I'll say thank you. And at this time, will open it up for questions. Brant, do we have any questions?
Yeah, we've got a number of questions from a few different channels. So I'm going to do my best to kind of aggregate them and get the most common questions answered. So the one question that has popped up a number of times here is sort of your opinion on using gross income versus net income in terms of the needs analysis calculation, the benefits of using gross income that was used in the example, essentially.
Got it. Well, okay, so there's a couple of different reasons why the gross income does still make sense. Number one, once assets get invested, there is going to be further tax. And whether it's short-term capital gains, long-term capital gains, however that translates, there will still be taxes on that money as you draw down for income purposes. In addition to that, I remind you that that 200,000 that we used for Mr. and Mrs. Jones was kind of frozen at 200,000. It's highly likely that your client would have enjoyed raises and things like that. And what we've seen based on calculations and a lot of math around all of this is that it's pretty safe to say using gross income is going to do what you need it to do for your clients.
Thank you. There's a number of questions regarding the tools that you provided, including the PowerPoint. Those will be sent out proactively to everyone attending the session. So we will, within 24 hours, have those to everyone. There's a question about, the affordability. In one example used, I think an $8 million recommendation, another 6.5, and whether a client who's receiving that recommendation the likelihood of them being able to afford that amount of death benefit.
Well, if you're receiving an $8.5 million recommendation, it's because you have a rather substantial income. So just keep in mind for a moment, we said that a $200,000 income for 20 years would require $1.5 million. Okay, so if you look at $1.5 million and I multiply that by give or take 6, that means that you're talking about a client with a $1.2 million income. And at that point, the amount of premium is commensurate. It's no larger percentage of their income than it is for the person that's making $100,000. So relative to their total income, I don't think it's a shocker. Much in the same way, that same client might be looking at their house versus somebody else's house. If they're making that kind of money, they probably live in a much more expensive home. They would expect to pay a great deal more for insurance for that home as compared to somebody who lives in a much less expensive home would pay less. My personal experience with all the meetings that I've been taken in by advisors is that is almost never, if ever, the reaction from somebody who really has been through the needs analysis process.
Yep. Okay. One advisor asked, I tend to put the present value of their current income minus what they need after debts are paid off through the insurance. Is this the wrong way to complete this?
I don't think it's the wrong way to complete it, but I think that, I think most financial advisors would agree that flexibility is really helpful when it comes to a plan. And I don't think the assumption that, debts are going to be retired or paid off or whatever, that all those things are going to happen. I think you want to be flexible enough to be able to do what makes the most sense at the time. Now, if the family is going to downsize a house or do something different, if whatever the case may be, then I certainly understand that. But I'm not a big fan of underinsurance, as you may have guessed. And I'm always amazed that I discussed my friend who had a fire and the amount of insurance. I mean, at the time of claim, telling somebody that you have far less coverage than would actually be needed to replace the income is like telling the person whose house burned, you have far less coverage than what's going to be needed to replace your home. I just don't think that's a conversation that anybody wants to have. And I understand about wanting to save money at the time of application, but everything changes when you're talking to your client at the time of claim.
Okay. And if you're looking at, for somebody that's young and looking at 30 years of income protection, is that also going to be a situation where the premiums may be too high for them to deal with?
Again, premium tolerance is obviously a personal thing. And if I've said it once, I've said it 100 times. Your client, if they drive up driving a fancy car and then are balking at the premium to protect their family, I'm questioning exactly where their priorities lie. And really, you have to come down to recognizing this needs to be a priority. And if they feel they can't afford it for a young couple at the time, then certainly looking at making the purchase and then adding to it in the future makes a whole lot of sense for them. You might look at laddering term insurance plans, something we can talk about in terms of helping. But I don't know how many of you have looked recently, but when you're talking about young, I don't know what young is to the person that asked this question. Young to me is anybody younger than me. But anyway, young, if you're talking about somebody in their 30s, for example, you would be shocked how inexpensive term life insurance is and how easy it is to implement a plan that includes a significant amount of insurance coverage without putting them into any kind of a financially difficult situation.
Okay. And then last question here is, if they have group coverage, is your opinion that that should be considered in the needs assessment, or, as it should be considered as a deduction or disregarded, or what are your thoughts on that?
That's a great question. And the quick answer, and this is very opinionated, I will tell you, in my humble opinion, I would not encourage you to include that in the needs analysis. And there's a real simple reason why: portability. While your client is employed, they may have that group coverage. And if they change jobs, they may not, leaving them in a difficult insurance situation. I would encourage you, you can't ignore it on one hand, but on the other hand, I would not allow it to play a very big role in the needs analysis process, as your client is going to need that coverage wherever their job opportunities may take them.
Okay. Well, we are right up against our time. Thank you, Michael, for the presentation. Everybody, thank you for attending today. In the chat feature of this session, so if you go hovered over the bottom of the toolbar, you see the chat feature. I've posted the CE link several times, so just go click on that link, enter your CE credentials, and we will get working on that. Also, we will be sending a proactive email with all of the material that was covered today. And of course, if you have any questions about any of the examples or tools that Michael used, or how to submit a term case or anything like that, just reach out to any of your friends at BUI. Enjoy the rest of your week, and thank you for attending.